from her, or for her, as being paid out. Well, I'm sorry, the burial expenses will not be deductible. I was getting ahead of myself. The burial expenses are not deductible, okay, expenses for tax purposes. But the medical expenses in 2007 and 2008 were not paid until 2008, so we can deduct those as medical expenses. And then the church pledge, because the Lees paid that on her behalf, they will be able to deduct that $600 as a charitable contribution on their Schedule A. And then you see, besides personal and household effects, Vivian's major asset was life insurance, and she designated the beneficiary of the policy to be Betty, and it was paid $20,000 proceeds that Betty received. On page 5-7, you will find in your book that the receipt of those life insurance policies are not going to trigger taxable transactions, and so they are not taxable. It will not go on the return. Number 14, we have interest income that will need to be reported, jury duty fees. The yard sale resulted in a loss. They got $950 with a cost of $1,800. That is a personal loss. They will not be able to deduct that loss. So we won't include it in income, but we won't deduct the loss as well. The expenses incurred by Betty for jury duty pay are going to be handled as commuting expenses, so we will not be able to deduct those because they are commuting expenses. She will need to include the $420 jury duty fee though. In addition to items already noted, the Lees have the following expenses. We're on number 15 now. Medical and dental bills, ad valorem taxes, interest, home equity loan, so it's secured by the home, so we're okay there. And then charitable contributions not including Vivian's pledge. We will be able to deduct all of those on Schedule A of their return. So all of those are. Also, if you'll see that they have 420 miles for medical expenses on the post that I gave you for mileage. Medical mileage for 2008 was 19 cents. So 420 miles times 19 cents will be an additional medical expense that they can take. And also the sales tax on the purchase was $1,600. Page 10-15 explains that if you live in a state that does not have income tax, as they do in Wyoming, then you can either deduct sales tax on major purchases or the income for that state, or the income tax for that state. So in this case, you'll want to take that $1,600 as an itemized deduction on Schedule A. Besides Vivian, the Lee's household includes two daughters, Meredith, age 19, Kirby, age 18, and one son, Toby, age 17. Kirby and Toby are both full-time students. Meredith works. It does not say anything about her being a student. She earned $9,000, so she earned over $3,500. She's too old to be claimed as a dependent because she's 19 and not in school, so Meredith will not be able to be a dependent on the return. That's key that you'll need to know there. Now, on number 17, they're giving you some information here. The Lees had an overpayment of $150 on their 07 return. It needs to be applied towards their 2008 tax return. Betty's income tax withholdings for the year are $5,100. In addition to that, the Lees made quarterly payments of $4,000. So the Lees have paid in $21,100. Then it gives you some additional information, the business code for David for Schedule C. And it says assume all other parties have the following Social Security number, 111-11 with a bunch of ones. I think the book is in error there, and I think we've already had some posts back and forth. Most software is not going to let you have more than one taxpayer with the same Social Security number. That's just not going to work. So I don't care. Just make up whatever Social Security number you want to give to them, as long as it is different for each one. It tells you to make the necessary assumptions for information not given in the problem. The taxpayers are preparing their own return. Assume that the taxpayers have all the substantiation that they need. The Lees do not wish to contribute to the presidential campaign. So as we do that, there's a few check items that I want to give you as you do the lease return. They will have total salaries of $38,000. They will have Schedule C income of $70,454. They will have Schedule D. Will have a net capital gain of $9,100. We will have Schedule E, which is their rental income. It's going to be $2,896. And again, on each one of these, well, on the first one you won't, but the rest of these, if you have some rounding, as long as yours is close to that number, you could be $2,897, $2,895, according to how you handle the depreciation. They will have Schedule B, which is the interest of $7,000. And they will have miscellaneous income, which is the jury duty, of $420. Then they'll have deductions from their AGI of between the IRA payment that Betty made and the KEO payment that David made. They're going to have $14,000 that they'll deduct away from AGI on the front page of the 1040. Health insurance premiums of $4,800. 1/2 of self-employment tax of $4,977 for an AGI of $105,093. So they're going to have an adjusted gross income of $105,093. To that, we're going to deduct itemized deductions of $13,742. We're going to deduct personal and dependency exemptions of $17,500. And so you're left with taxable income for the leaves of $73,849. So that should be your check figures for the leaves. Hopefully this video has been helpful. Hopefully this will help you get past wherever you are stuck. I will be posting another separate video for the HART return.